Hey, future CPAs, welcome. In this explainer, we're going to totally master a topic that's a big deal for your exam, factoring accounts receivable. Seriously, once you get the hang of this, it's basically free points on the LECPA. So let's lock this in. Here's the game plan. We'll kick things off with the why, like the real-world problem this whole thing solves. Then we'll cover the basics, get into the super important difference between recourse and non-recourse, and then we'll solve an exam-level problem together, step by step. And we'll wrap it all up with a lightning-fast review to make sure it all sticks in your brain. All right, let's jump right in with a situation you're pretty much guaranteed to see out there in the real world. This is the whole reason receivable financing even exists in the first place. Okay, so picture this. Your company just crushed it. 6 million pesos in sales. Your income statement looks fantastic. But then you look at the bank account, and it's totally empty. What's the deal? Well, this is that classic cash-rich but cash-poor situation. All that money is tied up in invoices, and you're just waiting and waiting for your customers to pay. Meanwhile, you've got salaries and rent due like yesterday. So how do you get out of that cash jam? Well, one of the go-to solutions is called receivable financing, and we're going to zero in on a very specific type, factoring. So what is factoring? In the simplest terms, you're selling your invoices to get cash right now. And here's the key thing you got to remember. It's a sale, not a loan. That's huge because it means you can take those receivables right off your balance sheet. It just cleans everything up. And this little diagram shows the whole flow perfectly. You've got your company, the supplier, who sends goods to your customer. You then send the invoice to your customer and to the factor. The factor immediately gives you a big pile of cash. Then, your customer pays the factor directly. And once that's done, the factor gives you the rest of your money minus their fees, of course. Simple, right?
Okay, now for the part that the LECPA loves to test. Factoring isn't just one thing. It comes in two main flavors. And the entire difference comes down to one question. Who's on the hook if the customer never pays?
So check it out. With recourse means the risk stays with you. If your customer flakes out and doesn't pay, you have to buy that bad invoice back from the factor. The upside? The factor charges you less because you're keeping all the risk. Without recourse is the opposite. The factor takes on the risk of non-payment. But for that peace of mind, you bet they're going to charge you higher fees.
Now, this term is absolutely critical. Recourse liability. Since you're holding on to the risk in a with recourse deal, accounting rules say you have to record a liability for that potential loss. It's basically you saying, okay, I estimate this much might go bad, and I'm responsible for it. Keep this in your head, because it's about to be a major player in our calculation.
All right, team. Theory is great, but let's get our hands dirty with a problem you could totally see on the exam. This is how we turn all that knowledge into actual points. Let's do this. Okay, here's our mission. We've got 6 million pesos of accounts receivable being factored. It's with recourse, and the value of that risk is 250,000 pesos. The factor charges a 3% fee, holds back 5%, and slaps on a 15% interest charge. We need to figure out two things. How much cash do we get today, and what's our total loss on this deal? Let's break it down. First up, the cash. It's pretty straightforward. We start with our total receivables, that 6 million pesos. Then we just start subtracting everything the factor takes off the top. So take out the 3% fee, that's $180,000. Take out the 5% holdback, that's $300,000. And finally, take out that interest charge, which comes out to $133,150. And boom, there it is. After all those deductions, this is the amount of cash that actually lands in the company's bank account right away. Mission 1 complete. Okay, pause. Listen up, because this is a classic LCPA trap. That holdback? It is not, I repeat, not a loss or an expense. Think of it like a security deposit. The factor's just holding on to a piece of your money to protect themselves. You're going to get it back later. So on your books, it's actually a receivable from the factor. Do not mess that up. All right, on to mission 2, calculating the loss. This is the true cost of doing this deal. What goes into it? Well, you've got the factor's fee of $180,000, you've got the interest of $133,150, and you have to add that 250,000 peso recourse liability. That's right, the value of the risk you're still holding is part of the loss. And there's our number. The total loss on factoring is 563,150 pesos. Now notice what's not here, the holdback. It doesn't factor into the loss at all.
This P563150 is the number you debit to loss on factoring when you make the journal entry.
Okay, let's bring it all home and make sure this stuff sticks for good. Think of this next slide as your retention hack, your ultimate cheat sheet for exam day. Go ahead and get that screenshot button ready.
This is it. These are the absolute must-knows. Factoring is a sale. With recourse, you keep the risk. Without recourse, the factor does. Memorize those two formulas for cash received and loss on factoring. And never, ever, ever forget that the holdback is not a loss. You get these down and you're golden.
And just to leave you with something to think about, we've nailed the calculation. But being a great accountant is more than just crunching numbers. How would you devise a client? Is factoring better than a bank loan? It's not just about the cost, it's about speed, risk, and what it does to your balance sheet. Think on that. Good luck with your studies. You've got this.